I want to bring in our Bell Point Chief Strategist, David Nelson. David Nelson, you're always getting real about something, my man. The recession, everyone said is this the same recession we've been getting real about for 2 years?
Yeah, the same one.
Okay.
And we're late on it. And there's a reason we're late on it. And you got it in the tease, it's about real rates. You know, if you go back to March last year when all this started, they started hiking rates. What we weren't really looking at was the real Fed funds rate, the Fed fund real rate. And at that point in time, it was minus 800 basis points. We've never been there before. All that hiking we saw last year, the bear market, everything, all the way up until March this year, brought them to neutral. We've only been in restrictive territory for a couple of months, and think what happened in March.
Connect the dots for people who aren't sure what you're talking about.
Okay,
here.
so it's the Fed funds
economy and markets.
Okay, it's the Fed funds rate minus the inflation rate.
Right.
And we haven't been restrictive until March of this year. Look what happened in March. Banks started rolling over. Signature goes under. Silicon Valley goes under. A few months later, we're getting companies like Macy's saying that we're getting rising credit card delinquencies. Just the other day, we had a JOLTS number that was better than expected, but it shows that the Fed policy is actually working. The economy is starting to slow. We're going to have a recession. It's probably late second quarter next year.
Although I read that Macy's report, and it would help if they weren't charging 34% interest, but that's a different story. But in a way, this is what the Federal Reserve wants. We had the inverted yield curve for almost 2 years, so it's been telegraphed in certain ways for a long time. The so-called recession is still, I think every single guest on today said, listen, maybe we'll slow down, but no recession.
Everybody thinks we're going that now, since we haven't had the recession yet, that we're going to somehow engineer this soft landing. If we don't get a recession, it's going to be the first time in a half century that the yield curve got it wrong. I say the yield curve is right.
All right. In the meantime, the market, the tug of war, you point to the tug of war. 10, let's call them maybe 10 stocks, right? This is a little bit more than 7. 10 stocks doing all the heavy lifting, the rest not. Everyone's pointed this out for months and months and months. My question is always, well, what changes? Do the 10 come down, or do the rest, the 490, go up?
It's probably a combination of both. I think there's stories on both sides of the market. You know, the AI boom is not just about NVIDIA, Microsoft, and some of the AI heavyweights. There's a lot of other companies out there that can participate in this, and that's the tug of war that we have right now. We have this problem that we're heading into recession, but we have some great stocks to buy.
All right, let's talk about one of them, because when I saw the name, I thought about that movie classic. You remember Superbad, right? The one character, McLovin. You like a company called AppLovin.
Right.
All right, tell us about it.
It's a surprising company for me because it came up in my models, and I said, what is this company? I look at the chart, down 92% from the highs at the start of this year and up 360% since January. So I started looking at it, and I noticed that the free cash flow was pretty high for a company this size. And ETFs like cash cows, ETF, COWZ, own the stock. I started doing the homework on the financials and said, I got to own this.
So you're okay with the volatility? So we have to have a caveat. Obviously, it's going to be volatile. It's
a hugely volatile stock. It moves 4, 5, 6% every day. It's only a $14 billion market cap company. So understand that going in, size it accordingly. It's a 1% position for me. That's how volatile it is.
Right. And I got 30 seconds. You also like Uber here?
I do like Uber. You know, I was on your show maybe back in early July. I talked about it. I think it's a great company. I think they're profitable now. The biggest risk for this company is obviously regulatory risk because they're a disruptor. But, you know, if the stock goes nowhere, the valuation is going to get cut in half because their earnings are growing
that they can never truly be profitable until they get all autonomous cars.
They're already making money. And they're going to grow free cash flow. Right. That's what tells me 50% next year.
All right, David. Good stuff, man. Thank you very much. All right, folks, coming up, my next guest.